Okay, our next speaker, Adrianna Alterman, she's the director of Salesforce Ventures. She's the Impact Fund Director, and I just can't wait to have you up here. I want you to come on stage and tell us a little bit more about yourself, because honestly, I know very little and I want to know a lot more. But what you're going to talk to us about really is about the corporate funding component. And I think I'm going to have a conversation with you if you're okay about that. I'd like to ask you some questions. So first, tell us, who you are and what are you doing in this space around corporate funding with Salesforce?
Hi, Patty. I am, as you mentioned, the director of the Salesforce Ventures Impact Fund, and Salesforce Ventures is the VC arm of Salesforce. So we are a corporate venture capital firm. Before we get into it, I just want to say on Jillian's talk, I could not agree more as a VC about how important it is to look for different funding options, and not every company is right for VC. And even more directly, VC is not right for every company. I actually just dropped in the chat. We wrote a blog last year about exactly this and just the different types of funding options that every company should think about as they're going through the process. So I'm going to talk today about one of those, which is a subsect of VC, but I just want to say that it is so true, and I tell this to companies a lot. Be careful about who you're partnering with and why. But I also have some slides to share, so I'm going to try to do that.
Oh, fantastic. Well, if you don't need me on this stage to ask you questions, I'll come in at the end. How about that?
That sounds great.
Come in at the end. Thank you.
So I'm going to chat today about raising corporate venture capital, what that is, and what you should think about when you are approaching CVCs. So first off, just a bit about Salesforce Ventures and my background. As I mentioned, Salesforce is the strategic investment arm of the company. Salesforce, for those of you who don't know, is a large enterprise software company, one of the fastest growing in the world. And we've been investing off our balance sheet for actually over a decade. We're now one of the biggest corporate venture firms in the world. We have actually over 5 billion in assets under management, and have invested in companies like Stripe and Zoom and Databricks and lots of other kind of top investments that you would know. So what is corporate venture capital? It's often called CVC. It is essentially the direct investment of corporate funds into startups. So we take balance sheet capital and we buy equity in companies just as a typical VC would. And if you think about the startup life cycle from kind of family and friends and angel and pre-seed all the way through public or exit, corporates usually play in this space, kind of seed to growth. That changes depending on who you're talking to and what they're doing, but it's very, very uncommon for a CVC to be the first money in. And it's more common that they're coming in kind of at a growth stage, kind of a Series A plus to be that strategic partner. And you may not know it, but there are thousands of CVCs, or over 1,000, I should say, CVCs across the world. So every logo you see here has a corporate venture fund or has made corporate investments out of their company. And Google even, for example, Google has at least 4 different CVCs inside of it or externally that it funds. So you may know GV or previously Google Ventures, Capital G. They also have Gradient. They also have Google Corporate Venture. Those are all different funds and pools of money and are invested in different ways, but it just gives you a sense of how broad the scope of corporate investment runs. And this trend, the reason there are so many of them is because the growth in this sector has been really kind of amazing to watch. Last year, halfway through 2021, CVCs investments had already surpassed the totals of all of 2020, which is, you're seeing these trends in general venture, but just to say that corporates are certainly tagging along, if not leading. And last year, exits jumped 95% just in H1. So they're very active. They're not just kind of behind the scenes. And this is true, my world, which is corporate venture impact investing, which when we started our fund in 2017 was a very rare thing to see, has now also exploded. And I can at this point name about 40 corporate venture impact funds, which if you told me that in 2017, I would have told you you were crazy, but is true. So just the opportunity that corporates are seeing here is really amazing. So I think the thing to know about CVCs is that they really, every single one is different. This is true of VCs too, of course, but I would say way more true of corporates. You really need to get to know them, and I'll kind of give you some tips on how to think through corporate investment at the end. But broadly speaking, there are kind of 3 buckets of corporate venture capital. And I stole this framework from TechCrunch, but I actually think it's a wonderful way to think about it and is true. So the first is what we kind of think of as institutional CVCs. Usually as fast as a traditional VC in decision making, diligence is going to look pretty similar. They're going to look at your product and your financials and probably go pretty deep. They have the ability to lead rounds. And most importantly, they usually have a full-time team. This is usually my trick to companies who are trying to understand what's going on inside a CVC. The fastest way to figure out what's going on is to figure out whether or not they have dedicated resources to their venture arm. If they do, it gives you a good sense that they are more on the kind of the institutional or hybrid institutional strategic pillar. On the strategic side, decisions can be a little bit slower, not necessarily very slow, but slower. This usually investments out of a strategic CVC are much more tied directly to the corporate. They can come from cash on the balance sheet, maybe there's different funds, but most importantly, they're really there to think about alignment with the corporate and what the investment from that corporate is going to mean both for the company and for what they call the mothership or the corporate itself. And then there's what are called tourist CVCs, which usually means they're doing one-offs. They don't necessarily have a dedicated team for this. They probably are not leading rounds, and frankly, probably shouldn't be leading rounds if they are. They're usually pulling money from finance and accounting and legal, and everyone's kind of contributing to do a deal. This can be a good option if it makes really clear sense for you as a company to have that corporate on your cap table. But I think it is important to understand what you're getting into with them and understand that they're really not going to look and act like a traditional VC in the way that some others would. So I want to leave some time for Q&A because this is a very big and vast field, but I just wanted to kind of leave you with 10 things to remember when you're raising from a CVC. So first off, spend time understanding the type that I just mentioned. What kind of CVC is this? And there are obviously hybrid models, but that'll give you a really clear sense of how to guide the relationship and guide the negotiation process. You want to ask up front about the value of the strategic relationship. Don't just assume that you're getting something from them or that they're going to give you support in some way. Be really clear in your questions about this and the strategic value beyond the logo. When you're going through diligence, it is very fair to ask upfront and directly about timeline and process to decision. As I said, these are going to vary a lot. And frankly, you're going to get a lot from the answer. Can the person on the other end of the line answer that question very directly? If so, that's probably a good clue that they've done this a lot. If they kind of waver and they're unclear, that also gives you some information that they might not be doing this a lot and your timeline might extend more than you think. The next is to properly prepare for diligence. Every CVC is going to diligence you slightly differently, but you can get a pretty good sense of what they're going to ask for depending on the type they are. So if they are more product focused, make sure the things in your data room for them are more product focused. Are they going to dig in on financials? If so, you're probably going to have to share with them everything you would that you would with a typical VC, or all of your projections, all of your historicals, etc. One thing that I think a lot of companies maybe don't consider upfront is the signaling that a CVC investment can bring. It can be a fantastic thing. It can show that, you have Google or Salesforce behind you. It can also be tricky for a company, especially at an early stage. What if having one platform behind you precludes you from partnering with another platform in the future? You should ask the CVC if an investment from them precludes any other future investment from some of their competitors or some of your future collaborators. So you want to think through all the implications of the partnership upfront. Similarly, you need to talk to them about the exit opportunity and the intention with the CVC investment. Some CVCs are investing to acquire, and others are not. We are not, for example. We have acquired our portfolio companies, but we have many, many, many more portfolio companies who have either IPO'd or exited to other companies, and we are not investing with the intention to acquire, but others are. And you want to think through what that could mean for the next 5 to 10 years of your company. A few more I'll go through quickly. Want to understand the ability and willingness to follow on. Some investors are thinking of this as a one-off. Others are actually putting capital towards future rounds to protect their dilution and also support you through the growth. And that is a very fair question to ask at the beginning stages. And this leads me to arguably what I would say is one of the most important. It is worth it to pay for good counsel. It can feel painful, and I know that. I would say this is true for CVC investment, from any investment, frankly. This is not CVC specific. Trust me, having good lawyers is really important for the company, and you don't want to be in a position where counsel doesn't fully understand the specifics of the round and the dynamics and hasn't had a lot of shots on goal at this with other companies. Get good counsel upfront. And then the last is just to remember, it's a two-way street when you get an investment from a CVC. You want to remember that you need to push for the value too. Don't assume they're just going to give it to you. You are in charge, and ask for what you want so you get it. Make sure you follow up, build relationships across the company. People turn over. You don't want to be in a position where your only relationship is with a single person who's no longer there. Kind of be the driver of the success of that relationship yourself, as you would in any other partnership. So that is that. If you want to learn more, you can obviously check out Salesforce Ventures. We have a ton of investments. Talk to founders. Talk to founders about what it's like to partner with that company. That is true of every investment, and that's also true of corporate. You're going to get a really good sense of what type of VC and what type of partner a CVC is from talking to other founders who have taken money from them. So I will there. Let's see if I can. No, one sec. Can you hear me and see my screen? All right. I'm happy to take questions. Lay them on me. I don't know if I should go to the Q&A chat or, oh yeah, I think Patty was going to come back on, but I can just go to the Q&A.
Come back on. Come back on. I'll help you with this. Yes.
Right.
I mean, really, this is incredible. And one of the things I got your 10 box up here because I thought it was really important. But when you think about when you are looking at the trends for what's getting funded in the corporate space, what are you seeing? Is it all over the board? Or what's your biggest recommendation when somebody is actually coming to Salesforce and they want to get some funding? What do they want to keep in mind? Those are two questions. I put them together.
It is all over the board. And I think one thing to keep in mind is some corporates are investing close to home, and some corporates are investing not close to home. And by that, I mean a software company, an enterprise software company investing in enterprise software, and a car company investing in car technology versus a B2B company investing in a B2C company. And my personal view, this is absolutely me, not necessarily anyone else, but I think it is important for a corporate to invest closer to home, both for them and for the entrepreneur. The value that an entrepreneur gets from taking money from a company that looks like them, except 10 or 100x bigger, is really different than than trying to create a partnership with someone that doesn't fully understand your space, doesn't understand the go-to-market motion. I'll give you a really quick example. During the pandemic in March 2020, when everything was so tough, we had a really scary moment. All of our portfolio companies, we did not know if they were going to survive this. Frankly, we did not know at that point if Salesforce was going to survive this. That looks really different today, but that is the honest truth. That quarter was so tough.
Oh, yeah.
And we ended up just doing emergency sessions with all of our CEOs and our execs on how are we handling this? Not how are we thinking about this? How are we opining about this? How are you actually sending people home? How do you do that? What is the legality around that? How are you responding to customers who don't want to pay? What are the contracts looking like? And that was really different because our companies, we invest in SaaS companies and we invest primarily in enterprise software.
Yeah.
They were getting asked the exact same questions we were, just on a smaller scale. So I think it is important when you're thinking about who to partner with, how well they know your business and why they're doing this.
Well, and do you think that the climate right now is much more cautious than it was before? Or how do you think, has it rebounded from your perspective?
I think that it doesn't stray too far from what you're seeing in venture generally, which is right now volatility and also last year extreme interest. I think corporates kind of follow the trends of investment, especially those that took venture money earlier. I think that's a big distinguishing factor. So, tech companies that were venture funded before they exited or went public or grew, they understand that life cycle and the landscape themselves. That's how they got to where they were, versus a legacy company who is kind of watching from the sidelines and maybe doesn't have that exact experience themselves. They'll probably be a little less interested or cautious to kind of get in on the waves of funding. So it really does vary, but generally, CVCs are investing in venture rounds, and venture is, a wild market.
Yeah, it definitely is. And then when you see what is getting funded out of your organization, how are you seeing the diversity and equity playing out in that space?
Yeah.
Especially, being part of Women in Cloud. So what's that look like for you, and how do you actually promote that?
Yeah. When we started the Impact Fund in 2017, part of the mandate was, in addition to investing in companies with a social or environmental impact with their product, was to invest in diverse founders. And today, just the Impact Fund's portfolio, we have over 60% of our founders are led by a diverse CEO or founder. 60% of our companies, I should say. I think it's been it's tough for founders. And I'm currently kind of talking to one now and supporting them through, a really difficult time, and they're fundraising again, and it's hard again. But I think that, you saw the numbers from Jillian.
Yeah.
I think, though, that I've really learned that if you change who's investing, you change who's invested in. There are so many levers in this sector to pull. But I really think that diversifying, it's not just diversifying founders, it's diversifying the investor set. Who has the purse strings at VCs? Who is bringing deals to the table? Who do they know? A lot of deals get done behind the scenes, whether or not it looks like that. And that is the truth. And so as much as we can, I think, diversify the investor ranks, you're going to see the ripple effects of that quickly.
Well, I love that we've added this to the stack that Jillian talked about, because we really then get to see there are so many different places that you can get funded as an entrepreneur with your company. And so where you choose to go just depends on what you want to get out of it and what it looks like for you in the future, right? And some choice points that you would make. So when you're thinking about as she was talking about all the different kinds of funding that you can get, VC or dividend models or loans, and then you think about corporate funding, where do you stack in that, and what would you promote about what it is that corporate funding that's different from some of these others that she was talking about?
So I think it's important to mention that this is corporate venture capital specifically. So what I was talking about, which means it's squarely in the VC bucket of things. You are definitely buying equity. And in terms of kind of how that stacks up against VC money as its own bucket, I think that the opportunity to work with a corporate is and what a corporate can bring to the table is actually incredible and real. I kind of just talked about, what happened during the pandemic.
Yes.
It's very different to work with a company who lives your kind of sector every day and knows the market. However, they are beasts sometimes and can be slow moving and frustrating, and all the things that people complain about can be absolutely true. So that's kind of the plus and minus on the VC side. But just to note that corporates do other funding that is not just VC. Some corporates do debt, some corporates do grants. The stack that she mentioned almost exists with a corporate lens. VC is kind of the most favored, I would say, because we're here today. We're talking about different types of funding models because the default is often VC, even though it maybe shouldn't be. So a lot of corporates in their innovation teams will do venture, and also because they're usually not leading rounds a lot, so they're really following on to what's already established. But absolutely talk to corporates about different types of funding. And we did non-dilutive grants during the pandemic just for small businesses. That was just essentially a donation. That wasn't my team, but that was Salesforce. Yes. So there's a lot of ways to get money from a corporate that aren't CVC.
Yeah, fantastic. Oh my gosh. This was kind of, I'm a little swimming to stay above the surface here, but I just was so grateful that you broke that down in such a clear way so that we could have just the two of you, you and Jillian, talking about this really helps to understand the landscape that people are working in. So thank you so much for your time. Does anybody have a final question for Adrianna? Anybody have a question that you'd like to just throw in that hopper? And if not, we're going to move back. I'm just going to look in here and see if we've got any questions.
I can answer one. There was a one on capital investments versus in-kind.
Yes.
So are we giving money? Or are we giving support? On the institutional capital for CVC, that is almost always money capital. It can come from the balance sheet. It can come from a separate fund. For Salesforce Ventures, it is capital. We take Salesforce's cash, and that's what we do with it. But there are also in-kind, if you want to call them investments, they can be structured that way, in-kind support. This can be really interesting, and I would just very much say, I can't emphasize enough, to know what you're getting up front. What are you getting? What are you giving? Is it on paper? And be clear that you have been thoughtful about what you are getting. So maybe if you don't get it later, you can go back on the in-kind.